Rogers, President and founder of 360 Financial. Go ahead, Mike.
Okay, thank you, and good afternoon to everybody. I'm going to just jump right into the presentation, and the reason is we've got a lot of slides to cover. As Jan said, my name is Mike Rogers. I'm the president of 360 Financial. Most of you on the call probably know me. If not, welcome. Love the opportunity to talk with you further about your finances. But today's program is just to give you some education on what we think is going on in the markets, a recap of what we covered last year, if you were on the presentation last year, and give you some ideas of what we're doing in our portfolios for our clients at the same time. So we will get right into it. Let's cover what we talked about last year. Again, we'll save this. It will be on our website if you're interested in reviewing it and going back to it. But we had a number of themes last year. First of all, we talked about the economy being fragile for the year and slow growth was going to continue despite the threat of the fiscal cliff. And the check mark means we got that one right. You got to recall last year at this time there was a lot of talk about recession. There was talk about how the government shutdown was going to impact the economy. We thought that would kind of go away, and sure enough it did. The economy grew in the fourth quarter at a 3.1% clip annualized, so that's pretty much right in line with what we anticipated, and we'll talk about what we think is going to happen this year. For last year, we also just said, you know, we don't think inflation is going to be an issue. It's always a concern of ours because so many of our clients are planning for retirement. And when you are retired, the biggest enemy that you have out there is inflation. You know, but we didn't see inflation being an issue this year. And again, I'll show you kind of what we were looking at, but we did get that one correct as well. Commodities we thought would be stronger on global growth. In 2012, we didn't have really the best year in commodities. They were okay, but we thought 2013 they would rebound. We got this one wrong. They did not rebound. And what ended up happening is that as the global growth did not occur, commodity prices also dropped, and that's going to be linked to another topic that we didn't quite get right either. But what we did get right was housing. You know, we thought that housing would improve with higher confidence and stable and low interest rates, and we had a very solid housing market last year, and you'll see why in about 15 minutes. Interest rates, we figured would be stable, slightly upward trending. And you might notice that we got it right with the check mark and we got it wrong with the X. So I'm not trying to hedge our bet here, but what I was just trying to show you is that the interest rate market was a little bit more topsy-turvy last year than we would have expected. As an example, last year at this time, the 10-year government bond was paying about 2% interest. So you invest $10,000, government would give you a couple $100 a year for 10 years and give you back your $10,000. So that's what we had last year at this time. And then until about May, the interest rates actually dropped. So it looked like we were going to be wrong on this prediction. Rates went from 2 to 1.6%. And then after that, it's like a light switch got thrown, and all of a sudden rates went from 1.6 to 3%, which is a pretty substantial increase in interest rates in a very short amount of time. So many bonds that were purchased or interest rate sensitive investments during the summertime. So a lot of downward pressure throughout the rest of the year. Because remember, interest rates and bond prices move in opposite directions. So now what's happened since the beginning of the year is rates have kind of trickled back downward, and the 10 years at 2.65. So 12 months later from when we did this program last, rates were about 2, and now they're 2.65. That's, if you will, an upward trend. Wasn't dramatic, but the ride along the way was pretty dramatic. So that's why I gave us a positive and a negative as far as the result on that prediction or that recap. U.S. stocks look relatively inexpensive. We did some parameters showing earnings to stocks and saying that stocks did not look like they were overpriced. They looked like they were actually pretty inexpensive overall. Now, of course, we did not predict that the S&P 500 was going to be up 300%, but we did predict that stocks looked like they were pretty good value, especially as compared to other things in the marketplace like gold. And again, we'll cover that some more. The emerging foreign stocks looked appealing because they looked like they were cheap. It looked like there was some value there. But this one ties right up into the commodities area. Because we had global slowdown, not global growth, the emerging markets were a rocky road. They still did okay for the year, and they were still positive, but they weren't as good as the U.S. stock market. First half of the year, they were down considerably. Second half of the year, they were up quite a bit. So we netted a positive return. It was okay in our portfolios, but U.S. stocks obviously did much better. And so I've given myself an incorrect on that theme recap, even though we still generate good returns. We didn't see the similar returns in emerging markets that we would have expected, like we had in the U.S. stock market. We talked a little bit about taxes last year, and I said, taxes are going up. If nothing else, capital gains are going up on most of our clients because of the way that they reset the capital gain rules from 15% to 20% based on your income. And everybody works for somebody, and if you're a business owner, you're going to see that your FICA taxes were going to increase because they were decreased during the Great Recession, and to give the employee more money in their pocket to hopefully go out and spend as a consumer, and that was expiring. We also had in Minnesota the tax increase for high-income earners, and we also saw a pretty dramatic shift in the reductions of deductions, especially for gifting purposes here in the state of Minnesota. So we got that one absolutely correct. And the bottom thing I said is, all of this is great. I appreciate you being here on this phone call, getting educated. But the most important thing is that you're working with an advisor, hopefully one of ours. We got 4 here in the office, and you have some goals, and you have a strategy in place. And what's more important is that strategy is what drives your portfolio and drives your financial planning. So that's a recap. We did overall pretty well for last year. So let's jump into what we're going to cover this year. Same sort of topics. We're going to cover the economy, housing, interest rates, and bonds, U.S. stocks, and international stocks. So I'll just get right into the economy. And the economy had a good year last year. Not great, but not recessionary. So what we have here is the chart that shows the gray area is going to be recessions. So here's a recession, here's a recession, here's a recession. And you can see what a recession is, 2 negative quarters of GDP growth or shrinkage in the economy. So for the third quarter, we had 4%, and for the third quarter, that doesn't quite work, but we had about 3.1% growth on an annualized basis. So you can see throughout the year we had, slower growth at these time periods. Had a good third quarter, and fourth quarter went into a reasonable number. It's pretty much right out with what we had anticipated, so we were happy with the results that we saw in the economy. And if you look at overall, we think this trend is going to continue. We don't think we're going to have very high growth rates up in this area. We think we'll be more in the 2 to 3% as far as U.S. GDP growth for this coming year. So if we go to the next slide and we look at vehicle sales, and sometimes we use this as a gauge of how well the economy is doing. You'll see here, you can follow my pointer, that we've had a substantial rise up in vehicle sales since the Great Recession. Some of you might know what this spike up was. This was the cash for clunkers that the government offered basically a rebate, a tax credit to buy cars. And the reason they offered it is the big 3 auto companies were hurting. There was a lot of inventory sitting around. Look where sales went from before the recession to historically low numbers. So came out with this program. And like most government programs, it was short-lived. Market conditions took over, and sales went back down. And they eventually, as consumer confidence increased and unemployment decreased, and cars just flat out wore out, people replaced them, and sales were looking pretty good. We're going to see this continue, we think, over the next year for some of the things that we're going to talk about here over the program. So that's a good sign. The consumer spending is a good sign for the economy. And the consumer spending Well, on a year-over-year basis, and that's what this blue line is representing, you can see the green line represents total cumulative spending and continues to increase. And it increases at a nice steady climb here. So the consumer is out there spending, and our economy is driven by the consumer, and the consumer needs to be out there spending. Look at the drastic results of when the consumer stops spending. We have a recession. Almost becomes a self-fulfilling prophecy. People get scared. They start slowing down their spending. The economy gets worse. They get more scared, and they stop spending. Pent-up demand kind of develops, and we see a pickup in spending. So these are year-over-year numbers, again, cumulative numbers. What's also good is that not only is the consumer spending, but the consumer or the household debt levels have actually dropped as well. And the combination of debt levels going down and the consumer spending going up is a good gauge for the economy, and works out well for the economy. The other issue of the debt load decreasing is typically your household net worth goes up. Now remember, net worth is everything you own minus everything you owe on it. And so if your debt load is going down, and maybe it's nothing more than just the carrying cost of that interest is driving down, that's going to help out your net worth. So what this picture is illustrating is a year-over-year change in net worth. And the blue line represents total net worth. So again, you can see we're at an all-time peak of total household net worth. And of course, the year-over-year number has a substantial drop in the 2008-2009 time period when not only were home prices decreasing, which is a substantial asset when somebody looks at their net worth, but also the retirement plans, their 401ks, their profit-sharing plans, their IRAs were also dropping. So you had two big categories of assets drop, and therefore, as those have come back up, we've seen a nice little pickup in overall net worth. Now, the net worth is important because there's this thing in behavioral finance called the wealth effect, and people go out and spend based on how wealthy they feel that they are. It doesn't matter if you're going to retire in 20 years and not touch that 401k. If it dropped and comes back up, you feel better about it. It doesn't matter if you're going to live in your house, for the next 15 years. It drops and it comes back up, you feel better about it. So it makes it more likely that you're going to, not sure what that is, more likely that what's going to happen is you're going to go out and spend and buy TVs, which again gets back to this consumer spending and the benefits for the economy. Okay. Another economic gauge that we're always watching is the unemployment rate. And so if you look at unemployment, it's been trickling downward, and we predicted that this was going to happen last year. So we reached almost a high of 10% back in 2009 and skyrocketing throughout the Great Recession all the way up from about 5 all the way up to almost 10, and then dropping gradually down to about 7. The reason we've been making this prediction now for a few years is because of this green line, which is its initial claims for unemployment. So as the initial claims drop, the unemployment numbers drop. Okay, so this is good for the economy. Obviously in the state of Minnesota, we're at about 4.5, which is even better than what we have on a national basis. Areas like North Dakota are literally at about 1.5%. Full employment is usually about 3. Once you get below 3%, you actually run into problems with the economy because you can't find workers. Usually what that means is about 3% of the people out there just won't work. No matter what jobs are offered, they're not going to work. And right now we're at 7, so we still have a ways to go. We see a little pickup here, but we do think that this will start trending back. They were trending downward some more, maybe approach 6.5, possibly as much as 6, but that might be a little bit of a reach for this year. Okay. While unemployment has been trickling downward, corporate profits have continued to increase. And you can see again, off these recessionary periods, we've made a substantial move upward in corporate profits. So if you look at this chart bottoming out in 2008, we look at the corporate profits in billions of dollars. Corporate America is pretty healthy, and part of it is they've been slow sorry, I wanted to go back here, to hire people. This trend of hiring is a much slower trend downward than the cutting of cost was upward. And so what you have is slower costs being absorbed by the companies and better profits being absorbed by corporate America. So that's good. Last year's corporate profits were up about 6%. Now the stock market was up 30, corporate profits were up 6. So that does seem a little out of whack to us. And it's something we'll address a little bit later. How about housing? I don't know if we have anybody in the housing business, either developers or realtors on the line, but housing had a nice year last year, and it looks like it's rebounding. One reason it's rebounding is the prices have come back up, not to the levels that they were, but they're coming back up, and the biggest reason they're coming is because of this chart coming back up. If you look at the month supply of homes, we're down to about 5 months of supply on the market as of the end of the year. Okay, now that might pick back up here in the summer or in the spring. More houses will come on the market, but supply is way down. Supply is basically at the same level it was in about 2004 or 5, really closer to 5. So we see low supply. Whenever there's low supply in anything, whether it's housing or any commodity, prices usually will tend to rise, and that's exactly what's happened. And if inventories stay at these low levels like this, there'll still be a lot of demand, decent demand for housing. That's usually good for the housing market. Okay. The other thing that's been good for the housing market and overall for the economy is delinquency rates have dropped. And so this is, again, a year-over-year change on mortgage delinquency rates, and you can see they skyrocketed in 2009, and the year-over-year number has dropped substantially over the last couple of years. So most of the people that were in over their heads on a mortgage, because back in 2004 and 2005, it seems like most of the lending institutions were making it very, very easy for people to get mortgages, almost obviously too easy, and that caused part of the reason for this huge run-up in the housing market, and then this huge delinquency rate number, and the housing market came down quite a bit. So this is a much more stable environment for the delinquency rates. Housing starts have been picking up as well, so that's also good for the housing market. Not near its averages yet. So what this is showing is your total housing starts, the blue lines. Very volatile, much more than we would have actually expected when we went back and did this research. But it's been volatile. We had this huge run up, obviously, in housing starts that occurred right in here, and then everything kind of came down starting in about 2005. We're starting to see a little pickup. We have, on average, about 1.5 million homes started a year, and we're only at 1 million homes started. So we have a ways to go to get back up to the averages, but our trend is positive. And with that low supply of housing, we think that this trend will continue. So how about interest rates? You can see I'm going through here really quickly, and I'm doing it for a reason. I want to be aware of your time. So if you do have any questions, you can either get a hold of us separately, or you can use the chat box as Janet had mentioned. But we'll just keep going through the presentation, and any questions that you have, we can try to address at the end of the program or during the program. So if we look at inflation and we look at interest rates, let's take a first look at inflation. And this is a price chart of the PPI and the CPI. CPI is the Consumer Price Index. And you can see year-over-year changes in CPI going back to 1984. Back here we're at about 4% inflation. Right now we're at 1.24% on the consumer level and only 0.71% at the manufacturing or producer price level. So very low inflation in this country. We anticipate that that's going to stay the course because we anticipate that the economy is going to continue to grow slowly. Usually you don't get a lot of growth in inflation unless you have a lot of growth in the economy. Okay. The capacity utilization at the manufacturing level has been trending upward. So you can see it drop down quite a bit. And it's potentially getting to the point where it might be a little bit concerning. And the reason that is if you look at 1984, when we got to about 80% slowed down a little bit, but when we got up to 85, we had a recession. Okay, when it got up to about 85, not too much longer, we had a recession. Okay, so now here we just got to about 80 and had a recession. This was driven more by the financial markets and the housing market than anything else. So right now we're sitting at 78.97, and we look at that and we say there's still room for manufacturing to grow, and there's still the potential to add on capacity, like Ford just announced that they're going to do in Kentucky by increasing their capacity in a big assembly facility down there. But overall, high capacity utilization is good as long as it doesn't get too high, as long as the factory is not too busy cranking out widgets that they're trying to keep up with demand too much. That sometimes means that demand might be on the out there in the horizon. That's going to slow down. Okay, but we're not there right now, so we feel pretty good about that. We also feel pretty good about where yields are. And what this chart is it's just showing the comparison of a 10-year government bond versus a 2-year government note. Okay, and it takes the difference of the two of them. So, for example, if you have 2.5% or 2.65% interest on a 10-year, and you subtract out the 2-year, which is about 0.2, you get in here about a spread between the two of them about 2.45%. Okay, so what's interesting about this is when we look at the spread being positive, this is called a positive yield curve. These are all positive yield curves. Okay, so saying the relationship of longer-term rates, they are higher than the shorter-term rates. That's a normal condition. Every now and then, though, we get a situation where they aren't normal. And what ends up happening is that we have an inverse curve. And again, what's interesting is when we have an inverse curve, look how closely that is aligned to a recession. Okay, right now we're not near an inverse curve, and therefore we still believe that the economy is going to continue to grow at a relatively stable but slow rate this year, and that's going to be something that is positive for the U.S. Okay. So as I go to my next page, which is the 10-year Treasury yield, you can see we've had a tremendous drop in 10-year Treasury. So the yield has dropped from substantial levels up here at 16%. And some of you might remember these 16% yields. You could get a money market account that would pay you 12% or 15%. Okay, now we've seen a substantial drop occur over the years. A little pickup here, like I've already explained, but you know, we don't see another drastic move upward, at least this coming year, in interest rates. Okay, and the reason is because the economy, again, isn't growing that quickly. So this chart overlines the 10-year Treasury yield and GDP growth on a year-by-year basis. And you can see they do kind of move in lockstep. You know, we had GDP that was quite a bit higher during the 70s and mid-60s, and interest rates trended upward. Okay. GDP growth of 14% back in about 1979. Interest rates hit their peak shortly thereafter. As GDP on a year-over-year basis starts to slow down, the interest rates have come down as well. So we think GDP growth is going to be at 2 or 3%. There's not going to be a lot of pressure on interest rates going up, is the point here. Also, if you look at bonds and you say, how are bonds acting? There's all kinds of different bonds. There's government bonds, there's corporate bonds, there's municipal bonds. And sometimes other bonds will have better yields, better value in them than other bonds in the category. So this is just a comparison of a corporate bond versus a AAA corporate. So still investment grade, just a little bit lower credit quality. And you can see back here in 2008 during the crisis, what was going on was people were saying as investors, bond investors, we want to get a higher interest rate for that bond because it's a lower credit quality. It's only BAA and it's not AAA. Okay. Now it's still investment grade, but what ends up happening is that as an investor you get a lot higher interest for that bond purchase. But now what we're seeing is we're back to kind of normal levels. Okay, so we look at, we say there's not a big opportunity in bond spreads for our clients at these normal levels. So we monitor those. And then we also just look at other areas as well and say, is there somewhere else out there that has even better, fundamentals to them, better spreads. So as we look and we get into, I'm trying to get this next one to move here for us. Oh, so I went back. Sorry about that. Floating rate funds. These are bank loan funds, very short duration. We've used them in our portfolios and we like them. But again, the values are about average, about normal from what we would expect. Where we see some values for the non-retirement account, especially for the high income earner in Minnesota, is Minnesota municipal bonds. And this is just showing a comparison of a yield to worse than a 35% tax bracket equivalent bond versus a taxable corporate bond. And you can see there's a big spread in here, 4.7% to 2.4% on these bonds. So again, you might want to talk to your advisor about where are the values in the bond market, and you would never put a municipal bond inside of a retirement account, but they do pay state and federal tax-free interest. And here in Minnesota, that might be something that would be a benefit to you, but your advisor can talk to you about those specifics. Okay. How about commodities? Well, as I mentioned, commodities didn't do as well as we had thought. What ended up happening with commodities is it kind of stabilized with a couple of factors, but big part of it was global slowdown. So this is a chart I've used in the past, and I think it's a good one because it illustrates oil consumption versus the price of oil. And so the consumption's the gray bar, and the blue bar is the price per oil, and you can see that it's come off from its highs of over $100 a barrel, and we're sitting at about $92. This is what they call light crude price, West Texas Intermediary light crude price. So it's about $92. Now you can see it spiked up back in 2008 and then had a dramatic drop down. And this was just another bubble that was going on. This was speculation that caused it. It certainly wasn't demand, because look at demand, it actually dropped a little bit. So it ran way ahead of demand and then came tumbling down. Right now our price is actually below the demand bars, which is kind of interesting, and we attribute a lot of that to what's going on in the oil industry right now, whether it's in North Dakota or other areas in the country where they have the Bakken type of shales that people are using the new technology of the horizontal fracking and getting that oil and natural gas out of there. I'm going to come back to gold in a second, and you can see what's going on in this country is we're drilling for more oil. The rig count for oil has grown substantially from 2009 up to these present conditions. We're stabilizing a little bit here, while at the same time natural gas rig counts have dropped. And part of the reason is when you're in these shales and you're doing the fracking, as a byproduct, you get natural gas. So we think that this trend of oil exploration in the United States is going to continue to occur. And as that continues to occur, that increases supply. It also looks at price points and says, we should see our gasoline prices either stabilize or decrease. One thing about oil is it's a commodity, so it does get speculative sometimes, and this creates trends that don't always make a lot of sense. But in this case, as Brent crude prices have stabilized and come down, gasoline prices have trended downward. So we think that trend will probably continue as well. Okay. And we also think, as far as the oil in this country, that there's some good investment opportunities to take advantage of what's going on in the drilling and the refining and the transportation of oil. So again, talk to your advisor about how that might make sense for you. How about gold? Last year and the year before, we predicted we didn't like gold. We thought stock or gold prices would probably drop, and we saw them drop this year. And if you look specifically over here, you'll see this is the ounce price of gold. It topped out right there at about 2010 after having this huge run up during the financial crisis, and now it's coming back down. Okay. We still think that gold is probably not the best investment for our clients. We don't have it in our portfolios. And the reason we don't is we don't see that it's a real big value at this point. we just see that gold prices are about normal. So what this chart is showing you here is how many ounces of gold would it take to buy the Dow Jones Industrial Average. So since gold doesn't have earnings, so they don't pay dividends, we got to compare it to something else. So the opportunity to buy stocks versus bonds is kind of what we're looking at here. And gold is expensive when you get to a scenario where it takes less ounces of gold to buy the Dow Jones Industrial Average. So the green line represents the average, which is about 12 ounces of gold. It's about 11 and a half actually. And you can see right now the blue line and the green line are kind of matched up. So we're saying that gold is relatively fairly valued as a comparison to the Dow Jones Industrial Average. But it's not cheap like we had back in here, and it's certainly not expensive like it was, excuse me, I've got that backwards. It's certainly not cheap like it was when it was here. And it's not quite as expensive as it was a couple of years ago because of this price decrease. So for this coming year, gold is not something that we most likely at this point be looking at adding into a portfolio. Stock market had a fantastic year last year, and this chart kind of illustrates a little bit what's going on. This is 10-year rolling time periods of the stock market, the S&P 500. And so again, 10-year rolling time periods. So from example, 1940 to 1950, roughly right here, your 10-year average annualized rate of return was about 2.5%. Okay, and then it ran way up to about 15% in 1960. So from 1950 to 1960, the 10-year number was about 15%. And then late 70s, again, we got down to 0. And then in 2000, we hit a kind of an all-time high of 10-year average rate of returns of about 16%. And then for the first year of the 10 years, I should say, of the millennium, and we had 2 market corrections. We had a negative 5%. You can see how unusual that negative was over a 10-year rolling period, and we're trending back upward. So that's good for the overall market, and it's good because what's been driving the stock market recovery is the stock earnings. And this is just an illustration of what the earnings have done over the years. And as you can see, and we talked about earlier, S&P 500 operating earnings per share are climbing, and the estimates that are out there, not necessarily our estimates here at 360 Financial, but the estimates out here is that instead of $110 a share earnings, it'll be $120 a share earnings for this coming year. So you got about an 8% increase in earnings is what's expected. That's also showing you what the risk is, because when the earnings drop, stock markets tend to come down in price. So what this chart is illustrating here is the S&P 500 earnings in the blue line and the S&P 500 index in the green line. And you can see when the index prices are way higher than corporate earnings, you have a situation where the market's clearly overvalued, and this is what we had back in 1999. Then you get in a scenario like what we had with the Great Recession, with the huge sell-off. You have a scenario where the earnings per share have come down, and so have the stocks, and now we're seeing a trend back upward. So typically, stock prices do follow earnings, and if earnings continue to rise, and that's the big if earnings continue to rise, you would think that you would see a stock market increase. Okay. So our big risk is what's going to go happen with earnings. And if we have slow earnings because of a slow economy, that will be reflective in the stock market, especially the U.S. stock market. Now, here's a great chart on behavioral finance. And what it's basically showing is that 10-year time period, the time period of the S&P 500 on the black. You can see the up and the down, just like what we had with the 10-year number. Okay, and then it's showing the mutual fund flows into different types of investments. So the blue line represents when money is flowing into stock funds. Okay, and you can see that peaked in right about 1999 to 2000. So we had a peak right in here, and the market's corrected. The market's corrected a lot during the time period. And then when did we have most people selling their stock funds? After the market had gone down. So they basically sold after it had dropped, and they bought at the very high. Obviously, it's the opposite of what we want to do. There was a study done a while ago. I don't remember exact numbers, but it's something like if you look at the S&P over a 20-year time period, you probably get about an 8 or 9% return. But the average investor only gets about 3% rate of return. And this is why, because they do things like this. Again, we have another upward in the market. Not as much participation in people buying stock mutual funds, but they certainly participated on selling them. And it bottomed out right about probably January or February of 2009, maybe late 2008. Okay, the market bottomed out March the 9th of 2009. So everybody sold their stock funds and they bought bond funds. As the stock market rallies upward, people were ignoring it until recently, right there. Now what we see is a flow of money going into mutual funds that are stock oriented. So that gives us some relative strength in the market, but it also makes us weary a little bit about what's going on with the average investor and if they're going to have their timing incorrect again. Okay. Now, if we look at valuations, are stocks cheap or are they expensive? That's what this chart is showing us. And this chart is the average price to earnings ratio. And that's kind of one of the best ways to look at valuations. What are you paying for earnings in the Russell 200, which are the 200 largest companies in this country. And so as you look at this, you can see the average comes in at right about 15. And right now we're at about 15. So we're seeing that, we're not cheap. Stock market isn't cheap like it was back in here, but it's not really expensive like it was back in 2000 as well. So we think it's kind of fairly valued when you look at the large company stocks out there. If you look at small company stocks, it's a little bit different picture. Small company stocks last year had a very good year with some small company stock funds being up as much as 40–50%. So you can see that price to earnings ratios have dropped way up above their averages. And that doesn't mean that it won't continue to go up like it did back in this time period, but it means our risk continues to increase as they get further and further away from this average PE ratio. So you can see back here in the 90s and the 80s, very low valuations, inexpensive stocks, got overpriced, and then got beat up again in 2008. We're now at fairly high levels in small company stocks. Okay. So if you look at the forward growth rates, how does this all play in? So we're looking at PE ratios, we're looking at growth rates, and in this service out there, basically this comes up with one-year growth rates for different types of investment categories. So to the top 200 Russell stocks, you have a growth rate of a little less than 8%. The 1,000 stocks, so it's 1,000 of the largest companies, have a growth rate that's a little bit higher, and you would expect that. Mid-cap stocks have the highest growth rate, when small-cap stocks are actually lower, which is a little bit unusual, because smaller caps usually have more risk and therefore would have a higher projected growth rate, but the service does not have it showing up that way. So that means that our portfolios might have a bent towards some mid-cap stocks instead of small-cap stocks, and it might be bent towards growth stocks instead of value stocks. So as an example, large cap value, if you look at historically, what's the current price to earnings ratio versus the average price to earnings ratio, they're pretty much in line. They're right about average. Okay? Nothing cheap going on here, but no huge overvaluation either. If you get down to mid-cap value stocks and you get down to small-cap value stocks, you see that there's a pretty big difference in the current price-to-earnings ratio versus what's historically normal for those asset categories. If you hop over to the growth side of this grid, and the blend is basically just indexed with both value stocks and growth stocks. So let's just look at the growth stocks. See, large cap growth tends to look a little bit undervalued versus its average price to earnings ratio. Mid cap growth tends to look a little bit undervalued versus its averages, where small cap stocks tend to look a little overpriced as compared to their averages. They're overpriced in here, and they're overpriced in here as well. So we're just saying that this category of small caps probably going to have more risk in it this coming year than maybe some of these other areas. So I've gone through a lot of information on the U.S. stock market, and hopefully it's something that it was helpful. Again, if you want a replay of this, we'll have one available. How about international stocks? Well, again, remember, we were looking for global growth last year, and we didn't get it. And one of the reasons we didn't get it is the leading indicators of other countries haven't picked up. And so this chart here is illustrating that point for me, and this is showing economic activity going on in different areas. Japan is the blue line, the Euro range is the red line, the UK is this purple line, China is the green, and the USA is the pink. So you can see if you follow the pink, our indicators dropped quite a bit during the recession, as you would expect. Slight upward trend, nothing really jumps right out at you. And so what we have with the green line, which is China, is we have a substantial difference as far as the trendward. We have this downward trend, and Euro seems to be coming up, UK seems to be coming up and a little bit, but China is slowing down. So if we looked at, I'm going to jump ahead, China manufacturing, this is one reason why. The manufacturing in the country has gone flat. Okay, so that's obviously not good. There's a few different reasons potentially. One of them might just be that their labor costs have increased over the years, and therefore more manufacturing is going to places like Vietnam than China, and because labor costs are still cheaper. The other thing is, with our low energy prices here in the United States and our abundance of natural gas, if power plants and manufacturing plants use coal, or they use any sort of energy to power their plants, that's usually their number one or number two cost of doing business. Labor and energy are the top two. So if our costs are dropping in this country, more manufacturing potentially could be or will in the future come back to the United States, because even though the labor costs are higher, the energy costs are lower. So that's what's going on a little bit there. But China has slowed down growth-wise. And if we look at these leading indicators, it shows up right in here. Okay, so what's going on with some of the developed markets? If we look at specifically Australia and Japan and Canada and the UK, these are price-earnings ratios again, and the US is this one right in here. So you can see, just again, we look a little bit more expensive than some of these other countries. And specifically, if you look at the UK, they look cheaper than us. And if you look at Germany, they look cheaper than us. So there might be some valuations in there that you'd want to talk to your advisor about in those areas. Okay. On the emerging markets, things look cheap. The problem is we don't have any momentum behind these country stocks right now. Look at China's trading at about 9 times earnings, and we're trading at 16. So we've got to really watch what's going on as supply and demand for those type of stocks this coming year. Right now, what we're telling clients is that we're a little weary of overweighting them in a portfolio. Having a little exposure would make sense, but not overweighting and instead having a small exposure to these areas. And if you look at a country like India, actually they have almost as high a PE as we do, so we don't see anything cheap in this Indian marketplace. And Brazil sits in there in the middle. I've covered the manufacturing, and I've covered a lot of ground here. So let me see if I can just wrap it all up and put it into an outlook for you for 2014. The big thing is the economy is stable, and we think it's going to grow slow. We're looking at 2 or 3%. There's other people out there with bigger predictions as far as the economy and growth rates, and we think that they might be a little bit too optimistic. So we're looking at stable, slow growth. Inflation, therefore, would stay low and remain low because we don't see any oil increases right now as far as causing inflation. We don't see any wage inflation either. So we're looking at oil production continuing to increase. This is a growth area for a lot of our clients. Utilize this, and we can use it in portfolios in different ways. So again, just talk to the advisors, but we like this area, and we like specifically the transfer of oil. So that's a lot of pipeline type of stocks. We like the drilling of oil, and we like the refining or the cleaning of the oil, if you will. Housing, continuous strong performance. We don't know really if housing prices are going to still go up 10%. That was a pretty big jump from the big drops earlier in the decade, but at least the housing starts should continue is what we're anticipating, and the housing market should continue to be strong. Now, what could mess that up for us is if interest rates would go up dramatically, which we don't see happening. We see interest rates at flat to slightly increasing, not spiking like we saw from the spring to the end of the year in 2013. So that was a big spike up in interest rates. They've settled back down. Interesting enough, they've dropped about 35 basis points or 0.35% from their high. And at this point, everybody knows the Federal Reserve is tapering their bond buying. And the bond market is telling us that this economy is going to grow like in the 2 or 3% range, like we're thinking is normal. Okay. So that means that with bonds, is you have your bond investments this year, we don't see any return from those bonds appreciating in price, or not very much. We see that you'll get your interest, you'll get your coupon, if you will, using old terminology, and that's fine. You know, you get your 2 or 3 or 4% interest, but we don't see any big price jump in the bond. And the reason we don't see that is because of some of those charts that I showed you earlier that show, you know, everything's pretty much in that normal range. There's no real big values out there. The only thing that would, again, take a look at for the people on the line here that are high income earners and have therefore very high income tax is maybe looking at tax-free bonds and discussing the risk of those with your advisor. U.S. stocks, we think those are fully valued at this point, obviously a little overvalued in some of the more aggressive areas like the small cap stocks, but there is a lot of strong relative strength. And so this bull market's been going on for a while. Up till now, we've had some weakness. We think this weakness and this volatility is something that's going to continue. So the stock market is fully valued. We've had the sell-off here in January. We built this about 3 or 4 weeks ago, so before this little sell-off. But we do think that it's a scenario where we have to be careful in what we're buying and when we're buying it this year. International stocks, you know, UK and Germany looks like they have lower P's than us. There might be some values in there to discuss with your advisor. The emerging markets are an area where there's some possible value, but we don't have a lot of relative strength, as I've already mentioned. So we're underweighting the emerging markets. And on the international side, we'd rather be in the developed markets, especially in dividend-paying type of stocks in those developed markets. If we can get a 4 or 5% dividend, those dividends obviously add greatly to our overall portfolio as they are paid out and can either get reinvested or put into cash. So we're really focusing on those on the international side. Because we think the stock market's, you know, kind of fully valued and we're seeing some volatility come back, we're just saying that the most important thing out of this outlook is make sure you have a plan to handle this volatility. When are you going to buy? When are you going to sell? You know, try to be proactive as much as you possibly can in a market like this instead of just reactive to what's going on. Each of our advisors follow a relative strength model, and we can at least look at what's going on with the supply and demand of stocks. There's obviously, and bonds for that matter. We, of course, don't have any guarantees or crystal balls, but we do have tools that we use to evaluate different items and kind of use those within the portfolio dynamics. But having a plan is probably the most important thing. And that's become evident this year as we started out the gates slow for 2014, which doesn't usually show up well in the entire year. So make sure you know what you're buying, why you're buying it, and maybe look for values out there this coming year. So pretty much I've covered it all, and I've covered it in about 50 minutes. So hopefully I didn't inundate you with too much information, but I think the program has given you enough education, a lot of pieces to look at that you're much better educated now than you were when you logged on. At least that is my hope. So at this point, I will basically hand it back over to Janet.
All right. Well, thanks, Mike. I just want to let everybody know you are unmuted. So if you want to, well, first of all, you can always do the chat if you have a question for Mike, or you can go ahead and ask it right now. You should all be able. We should be able to hear you all. So if you do have any questions for us, go ahead. I don't think I'm hearing any questions, Mike, and I don't see any chat questions, so I guess that does wrap it up. Thank you all very much for attending.
Bye.